stop what you're doing. Seriously. If you own regional bank stocks, or you're just trying to figure out where this sector is heading, you need to hear this. When I pulled up Huntington Bancshares' latest filings last week, what I found literally shocked me. Welcome to The Explainer. I'm your host, and today we're taking a deep, data-driven look under the hood of a bank that is completely defying gravity right now. Look, we all know the fear in the market, right? Elevated funding costs, margin compression, the whole regional banking sector feels like it's playing defense. But Huntington? They are playing aggressive offense. So let's just dive right into the numbers.
Because I want to start right here, 30%. Now, in the tech world, sure, 30% is a good Tuesday. But in commercial banking, a 30% cumulative earnings per share growth target over a 2-year window is a massive, surprising number. Management is projecting their adjusted EPS to surge from $1.45 in 2025 to somewhere between $1.90 and $1.93 by 2027. It's an incredibly bold target. The big question we're answering today is this: does the fundamental data actually back this up? Or is this just a massive value trap? By the end of this explainer, you'll know exactly what to make of it.
So here's our roadmap to figure this all out. We're going to work backward from that 30% target. First, we'll define the growth target itself, then unpack their highly revealing Q1 2026 earnings, tear down their massive acquisition growth engine, objectively navigate those scary macroeconomic risks, and finally, check under the hood of their capital strength.
All right, Section 1, the 30% growth target.
To understand how they actually plan to pull off a 30% jump, we need to look at this quote from CEO Steve Steinour. He talks about their differentiated super-regional model. You know, it's kind of like they're building a hybrid engine. They don't want to be a massive, bloated global money center, but they definitely aren't staying a sleepy community lender either. They are deliberately combining national scale with local, on-the-ground expertise. And this super-regional scale, that is the exact strategic bedrock they are relying on to hit those durable, long-term returns. Moving right along to Section 2, unpacking Q1 2026 earnings. Okay, notice the massive gap on this chart. This is a real game changer. From April 2026, Wall Street consensus had them pegged at just 16 cents a share for Q1. But look at the actual reported adjusted EPS, 37 cents. No way around it, they absolutely crushed it. They didn't just beat the street, they more than doubled the consensus estimate. Beating estimates by 21 cents in a single quarter shows us that their current operational momentum is running way, way hotter than anyone anticipated. So how exactly did they achieve a blowout quarter like that? Well, let's look at the core engine of banking, net interest income, or NII. As a quick refresher, NII is literally just the spread, the difference between the money a bank makes on interest-bearing assets like loans, and what it costs them to pay out on your deposits. In Q1 2026, Huntington's NII didn't just grow, it surged 33% year-over-year to a whopping $1.9 billion. That surge was fueled by a 27% explosion in average earning assets. They are expanding their balance sheet at breakneck speed. But here's the thing, relying purely on interest rates in this economy, that's risky, and Huntington knows it. So look at this breakdown. This is their non-interest income, basically their fee-based business, and it shot up 38% year-over-year to $682 million. Check out these numbers. Payments brought in $187 million, wealth and asset management hit $120 million, and capital markets almost doubled year-over-year to $132 million. This is a brilliant strategic pivot. By supercharging these fee-generating segments, they are effectively building a fortress around that 2027 earnings target, protecting it from crazy rate swings and funding costs.
Which brings us to Section 3, the acquisition growth engine.
Now you might be wondering, how did their balance sheet get so big so fast? The answer is M&A. Huntington has been on an absolute tear executing back-to-back mega deals. On the left, you've got the Veritex acquisition, a $1.7 billion all-stock deal completely integrated by mid-January 2026. Then, right on its heels is the absolute monster on the right, the $8.3 billion Cadence acquisition, which closed on February 1st. Together, these two deals are the main reason Huntington saw a 33% jump in average total loans and leases. We are talking about a loan book of over $174 billion now. That is just massive. But it's not just about getting bigger for the sake of it, right? It's about taking over the map. Look at this excerpt straight from their SEC 10Q filing. Veritex, headquartered in Dallas, Texas. Cadence, Houston, Texas, and Tupelo, Mississippi. Huntington is basically planting their flag aggressively all across the South. They're taking their super-regional model and injecting it into some of the fastest-growing commercial markets in the entire country. Of course, acquisitions are only as good as the math behind them, and here is the literal mathematical backbone for that 2027 EPS target. Management expects to squeeze out $435 million in annualized cost savings by 2027 just from cutting overlapping branches in tech. But the real kicker? $500 million in cumulative revenue synergies by 2028. They are planning to cross-sell all those treasury, payments, and wealth products we just talked about to their new Texas and Mississippi clients. If they execute this smoothly, these synergies are exactly the levers that will pull them to that $190 mark.
Let's get into Section 4, Navigating Macroeconomic Risks.
Because we have to be objective here, guys. It is not all sunshine and rainbows. Huntington's own SEC filings call out some very real economic headwinds. We're talking global energy constraints from geopolitical events, stubborn inflation, sky-high funding costs, and a labor market that's starting to show some real softening. For any regional bank, these are the exact factors that can absolutely crush profit margins or totally derail a massive growth timeline.
And honestly, you can already see some of those cracks showing up in the balance sheet. In Q1 2026, Huntington's provision for credit losses shot up 37% year over year to $158 million. Now, to be fair, a lot of that is just basic math. When your loan book explodes in size from acquisitions, your loss provisions naturally have to go up too. But they also reported actual higher net loan charge-offs, up $25 million from last year. So as this bank scales up, its exposure to bad loans is definitely scaling right alongside it.
Which leads us to our final part, Section 5, Capital Strength.
So how well insulated are they against those risks? That's where CET1 comes in, Common Equity Tier 1 capital. Think of this as a bank's ultimate financial shock absorber. It measures their core equity against their risk-weighted assets. And the news here is pretty great for Huntington. Even after swallowing the massive Cadence acquisition and continuing to buy back shares, they posted a rock-solid CET1 ratio of 10.2% at the end of March 2026. That is a fantastic safety cushion, putting them well above regulatory minimums.
And I absolutely love this next piece of primary evidence. This is a direct letter from the Federal Reserve to Huntington's CEO from February 2026. Because the Fed is currently tweaking its stress test models, they officially extended Huntington's buffer deadline. This letter locks in Huntington's stress capital buffer at a safe 2.5% all the way through October 2027. In a banking sector completely paralyzed by regulatory uncertainty right now, this gives Huntington's management an incredibly clear runway to chase that 2027 growth target without the Fed breathing down their necks.
So let's bring it all full circle. Can Huntington actually pull off a 30% EPS jump by 2027? Well, you've seen the data. On one side of the scale, you have a massive Q1 earnings beat, flawless M&A execution, booming fee income, and a rock-solid capital cushion blessed by the Fed. On the other side, management has to somehow flawlessly squeeze out nearly $1 billion in synergies while dodging inflation and rising credit losses. It is a wildly ambitious goal, but as their filings prove, they've built the exact super-regional machine required to try it. Which leaves me with a much bigger question for you. If Huntington can successfully pull off 30% growth in this brutal economy, what does that mean for the survival of every other regional bank playing catch-up? Think about it. Thanks for joining me on this explainer, and keep your eyes on the data.